Welcome to vTalkInsight, Market Drivers Daily for March 24th, 2026. Middle East tensions, an entrenched oil shock, and a hard reset in AI valuations are all pulling risk premia in different directions. Let us start with how geopolitics and energy are reshaping the macro backdrop. Geopolitics and energy have moved from a short, containable shock to something closer to a new regime for markets. The effective closure of the Strait of Hormuz and earlier attacks on regional infrastructure have already taken a sizable share of global oil and gas supply offline, and there are growing signs that a persistent risk premium is now embedded in energy pricing. That matters because it feeds straight into inflation, interest rates, and how much downside risk investors are willing to tolerate in equities and credit. On the ground, the Middle East conflict remains highly unstable. Ongoing United States and Israeli strikes in Iran, Iranian missile retaliation across the Gulf, and additional United States Marines and airborne units deploying to the region all point to a still elevated risk of further escalation. There is even discussion that a targeted strike on Iranian power infrastructure could trigger a nationwide blackout, which would deepen an economy already battling hyperinflation and a collapsing currency, as seen in the new 10 million rial note worth only a few dollars. At the same time, Iran's military capabilities look deeper than many assumed, with missile ranges now reported far longer than earlier estimates, an ultimate decision-making concentrated in the Revolutionary Guard, making any diplomatic breakthrough harder to secure. The Strait of Hormuz sits at the center of the macro story. Earlier disruptions were already estimated to have removed hundreds of millions of barrels from the market, and today's indicators point to a structural shift rather than a brief outage. Oil infrastructure damage across the Gulf, plus lingering control issues over key islands near Hormuz, support the idea that the pre-crisis baseline of $60 crude has been replaced by something closer to $80, even before adding any escalation premium. Current pricing, with Brent repeatedly trading above $100 and physical barrels changing hands at hefty premiums, suggests futures curves may still be underestimating how tight the real market is. Scenario workaround oil now spans a wide range. If flows through Hormuz remain heavily constrained into April, several analyses point to Brent moving into the $120 to $125 area, with more severe outcomes, including levels near $150 in the event of a prolonged disruption. Risks are concentrated in a few choke points. The strait itself, the Saudi east-west pipeline system that could be vulnerable to Houthi attacks, and liquefied natural gas capacity in Qatar that has already seen significant outages and even multi-year force majeure declarations. Asia looks particularly exposed, given its dependence on Gulf oil and liquefied natural gas. But Europe is also facing tighter gas storage and the possibility of further Russian supply cuts. The inflation channel is now clear. Persistent energy price shocks are expected to lift headline United States inflation by around 50 basis points this year, with some forecasts putting consumer price inflation near 4% and warning it could approach 5% if oil remains elevated. In Europe, officials are openly flagging stagflation risk, and markets have shifted toward expecting that the European Central Bank and Bank of England may have to lean more hawkish, even as growth momentum softens. For the Federal Reserve, energy shocks land on top of a fragile labor market and questions about growth, reinforcing the case for staying on hold while leaving the door open to further tightening if inflation expectations become unanchored. Rates and currencies are transmitting the shock. United States Treasury yields have pushed higher, with 2-year yields touching around 4% and 10-year yields moving above 4.4, reflecting both higher inflation risk and uncertainty over the policy path. The dollar has been tactically supported as a safe haven, helped by United States energy independence and relatively limited estimated GDP drag from current oil prices, while emerging currencies, such as the Philippine peso and the Turkish lira, are under pressure as authorities weigh how aggressively to use reserves or gold to defend their exchange rates. Global bond values have already shed over $2 trillion, yet credit spreads have only widened modestly so far, signaling resilience, but also leaving room for further adjustment if volatility spikes again. Equity markets are caught between these macro headwinds and ongoing dip-buying behavior. Global stocks are in their weakest month in more than 3 years, with futures on major United States indices trading lower again today, even as energy names outperform on the back of higher oil. Defensive sectors such as energy, materials, and staples are beating the broader market, while technology and software shares have derated, pressured by both higher discount rates and concerns that new artificial intelligence tools may disrupt existing business models. Investors are shrinking position sizes, rotating away from broad directional equity bets toward more thematic exposures in areas like supply chain resilience, energy independence, infrastructure and defense, and some sovereign wealth funds are signaling a tilt back toward domestic assets, which could weigh on global private market growth. Against this, there's a credible de-escalation narrative that markets cannot ignore. Multiple regional powers, from Turkey and Egypt to Oman and key Arab states, are pushing hard for a resolution that would reopen Hormuz and restore oil commerce, while reports of back-channel United States, Iran contacts, and a potential ceasefire plan suggest negotiations are at least being explored, even if Tehran's public stance remains skeptical. In a cleaner ceasefire scenario, most assets outside oil could plausibly retrace toward pre-conflict levels. The dollar might lose some of its safe haven bid, and energy risk premia would likely compress, though the underlying damage to infrastructure means prices may not return to the old $60 to $70 range quickly. The key watch points now are any concrete news on United States, Iran talks, signals on the reopening of Hormuz, and how upcoming inflation and purchasing manager surveys reflect the squeeze from higher energy costs, because those will set the stage for how volatility behaves from here. With geopolitics in the driver's seat, volatility across assets is being dictated more by headlines than by economic data. Oil has seen trading ranges that would normally unfold over a year compressed into minutes, with double-digit intraday percentage moves not uncommon, and similar swings appearing in equity futures when new information on the conflict hits the tape. Recent sessions have seen S&P futures swing more than 4% and crude prices move over 10% in a single day, underlining how sensitive positioning has become to incremental news. One striking feature is the outsized role of political communication. Markets have reacted sharply to shifting messages from the White House on United States, Iran tensions, with equities, treasuries, and commodities all whipsawing around presidential social media posts and official briefings. There have even been instances of unusual trading activity in oil and equity futures just minutes before major announcements, raising questions about information flow and adding another layer of uncertainty for risk managers. News of a potential United States brokered ceasefire plan between Israel and Iran briefly drove a sharp drop in oil prices and volatility in related exchange-traded funds, only for uncertainty over whether either side would accept the proposal to push risk premia back up. Traditional safe havens are not providing clean signals. Gold, despite heightened geopolitical risk, has seen its longest daily losing streak on record, while global bond markets have lost more than $2 trillion in value as yields rebounded. At the same time, the VIX Equity Volatility Index has not breached the widely watched 30 level, suggesting that, for now, investors still see equity downside as contained unless there is a further step up in the conflict. Even Bitcoin has traded more like a high beta risk asset than a hedge, declining alongside equities during recent Middle East flare UPS rather than offering portfolio protection. Market microstructure is amplifying these moves. Low trading volumes amid geopolitical uncertainty have thinned liquidity in both equities and futures, increasing the risk that relatively small orders can trigger outsized price action. Credit markets, by contrast, have held up reasonably well so far, with only minor widening in spreads despite the energy shock and higher yields, although idiosyncratic stress has emerged in places such as one large business development company that saw notable redemptions and a subsequent downgrade. If spreads and high yield continue to drift wider and volatility spikes again, flows could turn more decisively risk-off, pushing the VIX above 30 and putting additional pressure on equities. Positioning data and anecdotal evidence suggest investors are balancing fear of missing out with a strong risk management bias. There is persistent dip buying in equities, but also clear signs that investors are cutting gross exposure, shortening holding periods, and using derivatives more actively to hedge both downside and upside tails. Strategists point to convertible bonds and other hybrid instruments as ways some allocators are seeking equity exposure with volatility dampened by bond-like characteristics, though the broader message is that portfolios are being built for multiple macro and geopolitical scenarios rather than a single base case. From here, key markers for the volatility outlook include whether the VIX finally breaks higher, how quickly credit spreads respond to any further energy shock, and whether liquidity improves once there is more clarity on both Middle East developments and central bank policy. Amid all this macro noise, artificial intelligence remains one of the clearest multi-year growth engines, even as markets become more selective. Capital expenditure on AI infrastructure is expected to reach around $5 trillion over the coming years, driven by the move from simple chatbots toward more autonomous AI agents that require vastly greater compute and power. At the same time, real-world productivity gains are still emerging in specific business processes rather than across entire economies, reinforcing the idea that the AI revolution will be gradual, not instantaneous. The power system is becoming a critical bottleneck and opportunity for AI. Utilities are responding to surging data center demand by accelerating investment in renewables, battery storage, gas, and nuclear generation, with large players on track to add 15 to 30 gigawatts of new capacity by around 2035. Acquisitions such as recent moves in natural gas assets highlight a push to secure flexible generation and optimize siting for AI-linked facilities, while long-term, investment-grade offtake contract from data center operators provide visibility on cash flows. Geopolitical instability in the Middle East, including drone attacks on cloud data centers, is also nudging AI infrastructure investment toward relatively insulated regions like the United States, with Texas emerging as a key hub thanks to energy independence and land availability. Across the technology stack, the competitive landscape is shifting. ARM's push into designing and manufacturing its own CPUs for AI workloads, backed by expectations that the relevant market could grow from around $7 billion in 2026 to $60 billion or more within a decade, illustrates how chip architecture is evolving to meet agentic AI demand. Analysts continue to see firms like Microsoft as key beneficiaries of AI monetization, given their breadth across infrastructure and applications, while other major platforms, including Amazon and Apple, are deepening their AI strategies through robotics acquisitions and system-wide virtual assistant upgrades. Yet recent derating in leading AI names means valuations for some headline stocks, including the so-called Magnificent Seven, have merely round-tripped back to levels seen at the start of the year, underscoring how quickly sentiment can swing between exuberance and doubt. In software and services, dispersion is widening. Enterprise platforms that offer clear, measurable productivity improvements and deep integration into customer workflows appear better positioned than more generic retail software, particularly as investors question how quickly heavy AI spending will translate into earnings. Examples include real estate platforms using AI to automate agent workflows and create richer media, which are delivering engagement gains even though share prices have lagged as the broader property sector wrestles with cyclical headwinds. By contrast, some large software names have faced downgrades on concerns that margin expansion will slow as they absorb AI-related investment and fend off new, agentic competitors, while sector valuations have come under additional pressure following the launch of powerful AI tools by hyperscale cloud providers. Security and policy risks sit alongside the growth story. The window between discovering a software vulnerability and seeing it exploited has compressed from months to about a day, fueling demand for automated, AI-driven defense as legacy systems look increasingly inadequate and potentially set for disruption by cheaper, agent-based platforms. At the same time, security risks from autonomous agents themselves are rising, with adversaries potentially able to turn these systems against their operators, which raises the bar for guardrails and governance. Regulatory and procurement decisions are also shaping the competitive field, as seen in recent defense supply chain designations that threaten multi-billion-dollar revenue streams for certain AI firms and signal that future administrations could exclude domestic technology companies from government contracts over contractual disputes. The global geography of AI is evolving under the combined weight of regulation and geopolitics. Europe faces the risk that high compliance costs, fragmented rules, and persistent digital skills shortages push promising startups to relocate, even though advanced AI adoption could, in theory, deliver very large productivity gains for regional firms. Meanwhile, financial hubs like New York are attracting new digital asset and AI security businesses, and chipmakers and cloud specialists are exploring listings or expansion in the United States to tap capital for large infrastructure builds. Looking ahead, the trajectory of AI will depend not only on compute and capital, but also on overcoming three main constraints highlighted by market participants: scaling infrastructure fast enough, building trust in autonomous agents, and unlocking the rich contextual data needed to make those agents genuinely useful. To wrap up, Middle East tensions and the Strait of Hormuz disruptions are keeping a structural risk premium in oil, pushing inflation higher and limiting central banks' room to ease. That in turn is weighing on equities and bonds, even as investors continue to buy dips and lean on thematic exposures in energy, infrastructure, and defense. Volatility remains headline-driven and uneven across asset classes, with traditional safe havens offering mixed protection and liquidity conditions amplifying intraday swings. Against this backdrop, AI stands out as a long-term growth engine, but markets are becoming far more discriminating about business models, security, and policy risk along the value chain. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.